The IRS says this year's tax filing season will start on Monday, January 26th. And as you know, you have until April 15th to file your return. This month, this month is January, but it's also a good time for retail investors to plan how to minimize the tax hit and increase the value of your portfolio. It's an overlooked aspect. It's like the huge aspect of all of the stuff we talk about. Sharon Epperson is here with more on what people should consider. And there have been so many changes this year, right?
There have been a lot of changes, and it's so important to think about what you can control in light of your investments with uncertainty in the markets and all of that. And the first thing that you should be doing is taking a look at your tax advantage accounts. And there have been changes for 2026, an increase in what people can do in terms of contributing to tax advantage accounts like your IRA or your 401k. So the first thing is to look at the increase that we're seeing there. We're seeing about $7,500 is now the maximum that you can put into an IRA. That's a regular IRA or a Roth IRA. And if you're 50 or older, you can do a catch-up contribution of up to $1,100. Now, of course, when you're talking about Roth IRAs that a lot of folks like to do, there are income limits. But for people who are just starting out investing and just starting out saving for retirement, this can be a great place to start or a great place to supplement your workplace plan. Workplace plans, those contribution limits are also increasing up to $24,500 in a 401k plan, and a catch-up contribution can be as much as $8,000 this year. That's also an increase. And that's for 50 or older. If you're 60 to 63, you get to put in even more money, $11,250 is the catch-up contribution.
They're like, I want the money out. I don't want to be still putting it in.
Exactly. And this is whether you're doing a pre-tax 401k or if you're doing the Roth 401k.
You know, again, the tax rates have been moving around, and there's always tax strategies, loss harvesting at the end of the year and things like that. What else do you think people should be focused on to make sure they're ready for the best possible return this year?
Well, I think the people who are maxing out their 401ks are often older investors and those who are higher earners. And those folks have the opportunity to do a catch-up contribution often. I think it's important to realize that no longer will you have the choice about whether putting that catch-up contribution using pre-tax dollars or after-tax. Starting this year, your catch-up contribution, if you're 50 or older, has to be a Roth contribution. So you're no longer going to get that upfront tax break. That's something to consider as you're thinking about the tax strategy and where you're going to put your money.
But so much of this, Sharon, is about trying to control your own destiny as much as possible, learning as much as you can. The number of conversations I've had just in the last couple of years about what types of benefits or features workplace retirement plans have. Some, for instance, have this ability to put even more money in your 401k above the whatever $25,000 a year on an after-tax basis, up to around $70,000, I think, on that part. And then other plans actually have programmatic systems that will automatically convert pre-tax holdings in contributions into Roth holdings on a regular basis.
Those are all things that are very important to look at.
But they're not all available to all plans. So you actually have to do some work, right?
Exactly. You have to do some work to find out, because even if the plan is eligible to do that, the plan sponsor has to say, yes, our plan is going to be able to offer that. So it is important to see if you have that after-tax contribution, like some companies will allow you to do. And if you can take that after-tax contribution and then make it into a Roth, convert it to a Roth, is also a great strategy. Basically, the bottom line is when you're looking at tax-efficient strategies, you want to look at the asset location, not just what the assets are. So is it going to be in a tax-deferred plan? Is it going to be a Roth account? Is it going to be in a taxable account? And what assets should go where? Should you have your stocks in something that you can have tax-free growth and then tax-free withdrawals like a Roth account, as opposed to your fixed income or municipal bonds being in that taxable account? So that's important. You mentioned tax loss harvesting. That is important. We talk about that all the time, about selling that depressed investment and making sure that you can offset the gain. But tax gain harvesting is also important. You want to make sure that if you have great gains and you are a charitable person already, that's something you can put into a donor-advised fund, that appreciated stock.
And there's some change with that this year, or it's 0.5% or some, I don't know.
There are some changes for higher earners there, but the strategy is still the same. You want to make sure that you try to put those high percentage gains in something that's going to allow you not to have to pay as much capital gains tax. And so a donor-advised fund might be a great way to do that.
What do you call it? Tax gain harvesting.
There you
tax
go.
gain
Good
harvesting.
point.
All right, Sharon Epperson, thank you so much. Always news you can use there on more tax-efficient investing. Now, be sure to go to the Sharon's Money 101 newsletter at cnbc.com/money101. Sharon's got a lot of great news you can use with regard to financial planning and, of course, those tax-efficient strategies.